Good morning, everyone. Welcome again to day two of SaaSCon. My name is Nikhil Estrado. I head business development at Efficient Capital Labs, ECL. First and foremost, we are very honored and proud to be a sponsor at SaaSCon for the third year running. Very happy to support this SaaS startup ecosystem, not just in India, but also in the US. That's the India-US corridor where we operate. So before we dive in and invite our speakers on board, I'll just introduce you to a bit more about ECL, what we do, and why we're here, why we're hosting this panel today on funding options for tech startups. So Efficient Capital Labs, ECL as we call ourselves, has been around now for a couple of years. Our core offering is non-dilutive financing. This is growth capital for B2B SaaS startups, predominantly on the India-US corridor, right? So a bit more about how we operate. We are not a platform in the sense that we have secured our supply. Even before we launched a couple of years ago, we secured a $100 million debt facility from a US impact fund. And essentially what that means is the financing sits on our books and we have complete control on pricing, on the offering, on turnaround. We can make you an offer within 72 hours, right? Who is the financing for? Clearly, you need to have a B2B recurring revenue SaaS model. I'm sure everyone qualifies here. Typically, you need to have at least $100,000 of ARR history. And then the application is super simple. It's online, 15 minutes. It takes our team 72 hours to underwrite. Of course, we have a lot of technology integrations. And you get an offer. If the terms are good, you sign off. Money's in your bank the next 24 hours, right? So in the 2 years we've been around, we have financed over 110 B2B SaaS startups, predominantly on the India-US corridor. We've dispersed over $70 million. And happy to share that we made the public announcement yesterday. We've just completed our Series A round of equity financing. Now we've raised over $21.5 million in equity ourselves. So stable company, here for growth, and here to support the B2B SaaS startup ecosystem on the India-US corridor. So with that, just setting a little bit context for today's discussion, we're keeping it very open-ended. We're going to talk about all the financing options open for any kind of tech startup, of course, predominantly B2B SaaS for today's audience. And we're going to cover everything from bootstrap firms to considering angels, friends and family, and so on, going through the various rounds, seed, Series A, bridge rounds, and beyond. Working towards maybe a possible exit, whether it would be M&A or eventually IPO, which most folks kind of aspire towards on a long-term basis. And for that, I'm going to be doing the moderating. We have 3 CXOs from 3 diverse SaaS startups here today who are going to be interacting, sharing their own experiences of building their own SaaS startups, very different business models, different offerings, the various challenges they have faced through various stages of their growth, and the various financing options that they have considered and are actively considering even now, right? So we will hear it from them. It's going to be interactive. I would absolutely like to invite the audience to ask questions as well. Perhaps we can complete the initial discussion. There'll be at least, I think, we'll keep a good 5 to 10 minutes at the end for Q&A. I know we have half an hour in total. So with that, I would like to invite our 3 speakers for the day on stage. In no particular order, but Rajeev Kumar, who's the founder and CEO of Mystifly. Welcome, Rajeev. We'll also have each of them do a brief introduction of themselves. Next up is Suvidha Mehta, who is the head of finance at Synup. So as you can see, we have, welcome Suvidha. As you can see, we have folks who are also not just from different companies, SaaS startups, but also wearing different hats, right? We have CEOs, we have CFOs, we have a CSO as well, right? And a co-founder, Puneet from FINQY. Welcome, Puneet. Great, so with that, we can just test our mics. I'd like each of you to maybe start by introducing yourselves, your company, your offering, and then we'll dive into the agenda for today. We'll try and keep it interactive as well. So we can go in order. Puneet, over to you.
Hi, thanks, Nikhil. Morning, everyone, and morning, co-panelists. So I'm Puneet Lamba, co-founder and CSO. That's not a very common CXO position, but that's services. So my background is over 25 years. Started with, I'm an ex-army guy. So started my career back in the 90s in the army. And then I moved to the corporate bandwagon, started with IBM and all, went into quality. So I'm a master black belt in Lean Six Sigma production and all that. So this is my second startup. Started 5 years ago. I'm the co-founder, and FINQY is one of the fastest growing platforms. Actually, it's a B2B2C platform, and happy to be associated with ECL as well. Thanks to Nikhil. And we're one of the fastest growing platforms for financial distribution for all the finance DSAs, distributors, whether it is insurance, loans, etc., credit cards, all credit products. So yeah, happy to be on the panel today. Thank you.
Good morning, everybody. I'm Suvidha. I head finance and HR for Synup. Um, Personally, I have been in finance for a little over 20 years now. I've been working with Synup for almost 3 years. So Synup is an entity that's been around for almost 9 years. We are a listing, review, social media, and basically a page is location management organization. So in a very, very nutshell, we help our customers find our customer, and we also help them manage their reviews. We also, guide them on what type of sentiments as well as feedbacks that their customers are leaving for them, so that they can maximize not only their presence, but also their options available and acquire more customers in the process. Thank you.
Hi, good morning, everyone. Thank you, Nikhil, for this opportunity. I'm Rajeev. I'm the founder, CEO at Mystifly. Mystifly is a airline retailing transactional SaaS platform where we sit between airlines on one side and travel sellers or travel businesses on the other. And we offer a single API that integrates into over 500 different kinds of airline connectivity on the other side, along with a revenue management, a channel manager, the full stack which is needed to set up a flights business, run a flights business, automating end to end, is what we do as a company. My journey, of course, with Mystifly started with travel experience that I was on. I was on a flight traveling to London and gone into a situation where my ticket was non-changeable, non-refundable, and I had to buy a new ticket. And that whole experience of what I went through, I thought was a experience that others in the corporate travel space would encounter, are encountering, and that led to this opportunity to create Mystifly. A bit adding on to this, the journey from 0 to 3 million for us on the revenue side happened with no external capital, largely self-funded and driven through utilizing customers' money at the end of the day. And that's something which is another form of capital which is available besides the opportunities through external funding. So we utilize our customers' money very effectively in our 0 to 3 million journey, and from there on as well. We've been working with ECL now for a couple of years. It's been a fabulous partnership in how things have worked out between the businesses. So happy to share more and share more about the journey as well. Thank you.
Yeah, thanks for that, Rajeev. I think Rajeev has set a good segue for the platform as we dive into the actual conversation. So maybe we'll go in reverse order now. Rajeev, you did mention about your 0 to 3 journey, and a lot of startups when they first, I guess your very first round is probably going to be friends and family. You may start out with some kind of intent to bootstrap your way as long as you possibly can. Just so you know, ECL has over 100 customers. 20% of them are actually bootstrapped. Will they remain permanently bootstrapped and be the next Zoho? We don't know. But it's definitely a founder mentality, especially at an earlier stage. So would love to hear from you, Manish, Rajeev, about your journey of when you first started out. What was your mindset around getting your first initial financing? Was a typical friends and family kind of approach? Did you aim to bootstrap your way through the early 0 to 3 stage, or when did you start considering equity, debt, or a combination? Like how was your thought process around this?
The journey from 0 to 3 started with friends and family. Debt actually from friends and family, and not. Um, uh, it was a you know borrowing, in a way, a borrowing from friends and family to get the journey started. Some financing from my spouse, and that's how the journey started. But we were very fortunate that we could turn into being a profitable business in about 7 months of our existence. So we broke even in about 5 months, and then by the seventh month we actually started generating profits, and that meant that there was no real need necessity to kind of go and seek external capital, right? And we continued with that journey from that seventh month until we got to about 3 million, where we started realizing that not having adequate capital in a way impacts the speed at which you're growing, right? Because when you're bootstrapped and you're growing organically with your own revenues, then there is always a limitation in terms of to what extent you can drive growth and to what extent you can invest that money into growth. So that was a stage when we went and raised a Series A. But the good part in our Series A was that when I look back, we had time. So we were not really we were not in a hurry to raise money, and that meant that we had the choice of choosing the investor rather than being desperate and having any investor who came on board. And in that sense, when I look back, we were so fortunate to find Recruit Holdings out of Japan, one of the most compassionate, supporting investors that you could be finding on the equity side. We went through the most horrible period during COVID, where the travel tech as an industry was impacted massively, and they were there as a true partner to go and work with around a crisis of this kind. So there was no real push. There was no forcing you to take decisions to say this is what you should be doing. They did everything to support us in our journey, and and I think that could have only happened because when we raised Series A, we were not really in a hurry, and it took us almost like 8 9 months to close our Series A, talking through many investors and finally finding that money. I think um, once the Series A happened, then of course we went and relied on debt, because debt in a way brings in capital, which is non-dilutive, and helped us fund some of our strategic initiatives that otherwise, equity could not have, been the right instrument. So I think we went through that cycles of bootstrapping, going through equity, then debt, then another round of equity, and then balancing the next set of rounds with more debt, is how our journey has been. And in the process, yeah, we've not diluted a lot of a company as we got to a 10 million revenue. I mean, we've been fortunate not to dilute a lot of capital. And the last round of money that we raised that through Cornerstone Venture Partners, and again, extremely supportive investors. They, I think with the equity investors, they're literally like your partners, in that sense that you need somebody whom you can go and talk to, be very open, very transparent, very honest, and yet not be worried about the fact that they're going to, in some sense, be an obstruction to what you would want to achieve. So I think choosing the right equity investor is very important. I would say at this stage we've been very fortunate and lucky to be in that path of getting the right partners work with us. Yeah.
Great. And now we'll move on to Suvidha. Suvidha, you are the head of finance at Synup. I believe it would be a different journey that Synup has been through, and you've seen them through these different phases of growth. As someone who wears the finance hat of the organization, would love to also hear your views on how you have approached financing at different stages of the growth journey, where you're at today, and where you've come through, over the years.
So I think Synap's journey has been very similar to what Rajeev was earlier explaining about his entity. We started similarly as bootstrap, and initially went through friends and family round, and we said, okay, we don't want to dilute our ownership, and figure out how we want to kind of look at our internal money, internal resources, and see how do we want to validate our sales and our product. we then went through a round where we realized, through different interactions that this is what our product is sellable. The prototype is ready. We have customers. We have the initial revenues and initial, SaaS-based deals, long-term deals being done. So now we need to grow. And I think from the seed stage to the early stage, that's where it kind of matters. You look at options of both equity and debt. Equity, though it, you kind of dilute your ownership of the company, but it also helps you, one, get the validity of the market, validity from the investor, also helps you tap their resources, their connections, their network to figure out where, as an entity or as a product, your company stands. Plus, it also gives you a head start in the form of capital, which, like what Rajeev said earlier, would not have been possible to scale up your organization based on your initial revenues. So Synup also went through the same journey. We had our Series A round in 2019, and like any other SaaS company, COVID hit us during 2020, and for us also, most of our customers are brick and mortar stores in retail, or cold storages, hospitals, etc., which kind of took a backseat during COVID. But I think equity partners are both our investors, were very, very supportive for us. They understood where we are coming from. They supported us very, very nicely during that time, and we could have an open discussions with them, understand, kind of lay out our concerns and discuss our strategies as to how we want to go forward, how do we want to address the current situation, and they were there to guide us, and take us forward to the next level. During that time, after the equity round, we went to most of our debt round. I think it's most to balance out, because once you've reached, as an entity, we've reached a certain stage after a certain point of dilution, that we wanted a little bit more scale, but we didn't want to give away the controlling part, or the option of taking a lot of our decision in-house. We didn't want to dilute our equity, so we went through that way. This balanced our equity and debt. It also gave us a bit of capital to grow, but it also helped us, regulate that these are the fixed payments of the debt or repayment of the debt that we need to do. So we understood the fact that, this is something that we have to keep on paying for X amount of years. And, ECL has been a wonderful supporter through that journey, to help us understand this is what we need to pay at a particular point of time. And we were able to manage our cash flows accordingly. So, we are at that stage now. So we're kind of mixing up, balancing our equity and debt through that stage.
Thanks, Suvidha. And I'd like to go back to a discussion we had earlier this year, probably the first quarter when we met. And you have worn the finance hat function at large enterprises as well prior to this, right? And you probably, at that point of time, I remember you mentioning, tried to acquire debt from banks, large financial institutions, certain challenges around that as well. So, and now you've transitioned to a relatively earlier stage startup, right? So how has your experience been with access to finance with that transition?
So it was, as I say, quite north and south pole. I've spent initial years of my career with companies like GE and HP, where if you want to open your mouth and say, I need financing, and you have multiple banks, multiple vendors kind of coming and going through, round, okay, I will give you finance, what you need it from us. So, it's a very difficult, it's a very different stage when you are backed, or when you are, working and asking for a credit for $100 billion organization versus a $3 million organization. When we go through this, when we are at the stage of seed funding, where you're like, just after bootstrap, but still not reached your Series A financing, or you're probably around 2 to 3 million kind of a revenue stage, you would find, and that's been my personal experience, you would find that there are very, very limited options of debt. Whether it is through bank or it is through private, they're very, very limited options. Because if I look at from their perspective as well, any organization that wants to give you debt, they also wants to have a collateral. And at that stage, when you are only 2 to 3 million, you probably may not have enough collateral to justify the debt that you are taking. Most of your funding requirement is based on your future growth, which may or may not happen as per from their term point of view. So they would want to kind of play it safe and look at where their returns are guaranteed, and then they would want to probably go to much bigger organizations. So that was quite a lot of struggle. And at the start of the year, like Nikhil said, so we were discussing the way the organizations treat people very differently, because you are part of a bigger organization and a smaller organization. It's also because the fact that they understand that these are the organizations that have ability to pay you back, and these are the organizations that are trying to make it as a big. So wherever there is a high risk, there is a high reward, and that's what I think probably what is ECL is looking forward to. The startup like Synup, startup like Mystifly and FINQY, that is where there is high risk and high reward, and that's what kind of works through the debt during that stage.
Thanks for sharing that, Suvidha. And now we'd love to hear from Puneet as well. You've been part of, FINQY's journey. I've met your co-founder, Manish, in Mumbai as well. It's been a long journey. You all have known each other through the years. You've seen FINQY through various phases as well. I'm sure there's been all kinds of financing options that you've been through. So would love to hear that journey in your own words.
Yeah, thank you. So, yeah, I mean, we're a 5-year-old young startup. I don't know how young or how early stage, late stage. That's a very relative term in a startup, parlance. Uh, but FinKey, yes, we started as everybody, most of you would, start with the initial, our own monies, bootstrapped. And in fact, I was the first technical investor in FinKey. With my friend, we've been, through the school years as well. So we go back 45 years knowing each other. That's an advantage, having a co-founder who's a friend. So, but yeah, I mean, having heard both of them, they've more or less covered most of the financing options, while I would want to bring in just two more perspectives to it. And one perspective is, as a founder, are you clear that what do you need equity for, and if at all you need debt, what do you need debt for? Are these for the same usage, same purposes? In our case, we were very clear that equity money is only to be used for growth and expansion, maybe in scale or geographies, while debt we may use for workflow or cash flow purposes, right? So if, are you clear about that? Or maybe, as Suvidha was also saying, that you want to balance out how much equity you want to let out versus how much control you want to maintain, etc. That's another perspective you must be clear for. I want to bring in one more additional tool that the founders have access to, depending on, I mean, in a SaaS, of course, you have recurring invoices, recurring revenue. So there's something which, interestingly, even ECL helps you with, is invoice factoring. Now that's different from having a debt, whether it is a medium term, long term, or an equity. And invoice factoring happens when you actually need a very short term money to tide over the cash. You don't want to go for a long term debt and pay so much. So I think that's another interesting option. Like, we have had tie-ups with NBFCs, which helps us with invoice discounting on our invoices, right? So that we can pay our partners on time. Because, I mean, as in SaaS and other businesses, it's very important that you maintain your reputation or equity or brand equity in the market of being a partner who pays you absolutely on time. Now, that's very important in our, at least in the domain that we are present in. So I think that these are the two perspectives I would want to bring to the table for you to think about.
Yeah, thanks for bringing it up, Puneet. Quick clarification. So ECL's model is not specifically invoice discounting or factoring, but we do look at contracts which are longer term in nature, typically multi-year and so on. Having said that, we have flexibility on our USD financing side, where we can finance you for as short a period as 3 months, which is very much a substitute for your short-term working capital needs, and as high as 3 years, while the typical timeline is 12 months. Most of our portfolio is on a 12-month repayment basis. But also interesting to understand that very clear mindset which you've delineated, saying that debt, as at least for your needs, is very much a working capital shorter term basis, perhaps going into quarters rather than multiples of years. And equity is, so it's not a zero sum game here. It's not either or. It's very much a mix. And we've heard that from all three of our CXOs here today. They are, as they continue to grow, go through various cycles, they are tapping into both equity and debt on a needs basis. It's very much, an interplay. And we see that a lot as well at ECL, for instance. We partner with a lot of, accelerators, early stage VCs. This is win-win in many ways, right? Because you're helping founders and stakeholders, shareholders on the cap tables of these early stage startups protect their stake, protect their share while being able to continue to grow. And yes, from time to time, when you're looking at more strategic, longer term financing options, you probably would go back to considering, VC, and of course, with the implications that it has. So speaking of VC, again, wanted to revisit and again, engage our speakers here today. I mean, we've been hearing this ever since, let's say, ironically, after the end of the pandemic, we started hearing about the funding winter. Most people had certain assumptions around this is going to last 3 months, 6 months, a year. Maybe it's tied to, US interest rates and so on. And to be honest, it's been a couple of years post-pandemic, and we're still, to a large extent, perceiving a certain tap running dry. Funding, at least VC funding, equity, pure equity, is no longer as accessible as it was, and probably never will be as accessible as it was during the pandemic. That's probably a blip in the overall, multi-decade radar of financing. But going back to, just the perception versus reality, I'd love to hear it from your side as well. Clearly what we understand is that VCs do still have dry powder, but they want to double down on their existing investments, and perhaps stars within their portfolio to make sure they succeed, which has implications on the rest of the portfolio, any net new investments, right? So just from our understanding, and of course all of you also looking at VC funding, is this true? And by virtue of that, from your own experience, what implication does that have on your decisions to also tap into debt and so on?
I think during COVID, the pandemic, travel tech was the least favored, space as far as investors was concerned, right? So nobody even wanted to touch or speak to travel tech businesses in that particular era. And I'm calling it era because, again, it was very specific on what happened during that time period with respect to other industry verticals finding interest among the investors. So we really had a big dearth of or missed that bus when it came to finding equity financing during that particular period. And as the as things changed, and with travel again getting back to track, one of the key metrics that investors today track is the element of profitability, right? And in terms of how does your unit economics work, and from a decision making, it is no longer the same as what it used to be, let's say in that 21, 22 time period. So for us, we don't think this is the right time, because we see that in another 6 months down the line, there is a certain visibility that we have, and with that visibility of revenues, we think that we can protect our equity far better than going out today and raising money. But having said that, it isn't that we haven't gone and spoken. We've also tested waters. We've constantly had conversations to understand how investors are thinking, and I think the mindset is very different today from how it would have been, let's say, 4-5 years back, or 4 years back for that matter. So to answer your question, travel tech is not a space which had interest, is not a space which currently is seeing interest, unless there is clear validation of unit economics, yeah, and very clear path to profitability, or there is very clear growth visibility as far as the addressable market is concerned from an investor standpoint. And we're going through that cycle. And fortunately, we've just managed to close a bridge. And that again gives us a little leeway in terms of how we can utilize that money before we get on to a proper Series B round and then raise our next equity. But to kind of conclude on this, it's not at least what we are experiencing at this particular point in time, the metrics that investors are chasing is very different from the metrics that they were chasing 3 years back. I'm sure it's the same with everybody, and everybody's experience is no different. Yeah.
So thanks for sharing that, Rajeev. And again, coming to you, Suvidha, would love to hear from you about Synup's journey towards profitability and how that has impacted your decisions around equity, debt.
So, something like what Rajiv said, and what Puneet was saying earlier, the option why you want equity and debt as an organization is based on how an organization sees a need of funding and where they want to kind of utilize that funds. Um, we had our Series A funding raise before the COVID hit. So, once the COVID came, for us at that point of time, funding was not the major requirement. But if I talk about the general industry, the funding winters, as we call it, has both pros and cons. So, like what Rajiv was saying, there is, the metrics that the venture capital capitalists are looking for are very, very different. The approach that they are looking at is very different. There is a lot of, because there's a dearth of funding providers in the folio, then the competition has increased a lot. This basically means that, where you could earlier raise, say, $100 as a funding, now you're only able to raise $80. So which means as an organization, as a founder, as a startup, you're discounting your valuation much more than what you were discounting, pre-COVID or during the COVID times. So you have to be very, very careful on what and when you want to raise the fund, and it cannot be dependent on whether there is a, what type of fundings that options that are available. It should be more, first step should be more coming from within. Why do you need that funding, and what rationale you have for your funding? From sign-up perspective, because we are currently during this time, COVID time, we were not looking at fundings. So we were more post-COVID time is when we actually, wanted to scale up and grow. And for us, it was very, very clear that, we want the money that we want is for a growth of a particular segment. It's for initial investment to figure out whether, test a new market to understand whether our product is viable for that market. Build up a prototype and enhance the product for a particular region of the globe. We were very clear that this is not something that we want for a longer period of time. This is something that we want for a shorter period of time, because if that product does not work out for that particular country or that particular location or that particular industry, we probably may not looking at, kind of investing big time there. And that was the reason why we kind of chose debt, because that aligned with our rationale on why we are looking at a debt instead of equity. And that's where, when we reached out to ECL, like what Nikhil said in the introduction, it was a very, very simple process. Fill it up in online, and within 7 to 2 hours, the money is back into your bank account. And that helped us a lot to kind of accelerate our plan. And because we were looking for short term, so the need of the money was very short term, very early, very quickly, and quick turnaround. But coming back to the funding winter, I think the good part of funding winter, or probably money being available in the market drying up, as what we may call it, is also that as startups, all of us have kind of started focusing more on efficiencies of operation, relooking at what we are doing, why we are doing, whether it is sustainable or not sustainable. Like what Rajeev was saying, matrix has changed to profitability. The matrix is also changed to whether it is sustainable in a long period of time. As a company, we achieved our profitability immediately after COVID. That was before we were looking at debt funding as well. But I think a lot of startups, a lot of industry is relooking its inside to figure out whether how we can do this much better and much efficient, so that we may not be dependent on outside funding to kind of sustain and ride through this journey.
Thanks for sharing, Suvidha. And over to you, Puneet, on your views as well, and then we'll maybe take a couple of audience questions.
Yeah, so I would just want to give you some good news, guys. And the good news is that according to some numbers that I was, going through, the funding winter was supposed to be over earlier this year, and some people say it's still going on and towards waning, now. The good news is that a lot of these big VCs, big names, everyone is sitting on a lot of dry powder. The numbers, if I can speak of some numbers, in the first half of 24 this year, there's been a disbursement of approximately $5.5 billion. The prediction is that they want to invest up to about 13, $14 billion. So you have the better 6 months coming now. So that's the good news. How much money are they sitting on? Over $20 billion, right? And I hope, and I'm sure, there is some pressure on the VCs also to deploy that kind of fund available. It's also important from them, their perspective. They can't be sitting endlessly on these kinds of funds. So yes, it is a good time again coming up. But and I completely agree with both of them, you're more also focusing on the bottom line now rather than playing for only valuation, seeing the top lines. Now those multiples are drying up and people are asking questions on your bottom line, right? So that's important. And in any case, that was one of the first things as a startup, and especially when you started as a bootstrap, those are the things you anyway should inculcate as a culture in the organization, looking at efficiencies, other stuff. And one more thing, as Rajeev said, the good part in his case was that he had time. If possible, you must choose wisely, carefully who are your investors, especially when it comes to VCs and other, who are long-term players, who are there to support and who kind of share your vision and want to grow with you or you grow with them kind of stuff, right? So my 2 cents on that.
Yeah, thanks for that. And very quickly, if there's any questions in the audience, happy to take one or two, or we can wrap. We
Hi.
can take both. We'll come back to you. Yeah.
Hi, my name is Mosmi. I'm a founder of Zapscale. And the question I have is, since you are all further ahead in your journey, we're a little earlier in the journey, and what are the parameters that you should keep in mind when you're looking at debt as a financing option in the early stage of the journey? So we're already making revenues, but I need to understand what is the right option and what are the parameters I need to think about to take a decision. We should be profitable in a few months' time. So it's kind of a stage where I am unable to make a decision that do I need to focus on equity only, or is that debt an option, and may I delay that, which will give me a better negotiating power in the equity process? Thank you.
Whoever wants to take it.
Hi, Mosmi. Did I get
Yes.
Hi, Mosmi. So, Mosmi, debt option at an early stage, it's kind of a double-edged sword because at an early stage, you may not have a predictable and a regular cash flow coming in. Though the pros of debt is that you don't end up giving your equity, you still have your control, you still want to figure out where you want to steer your organization. The con of debt is that you have a fixed amount of payment going out every month. So unless you are very sure that there is going to be a top line which can support this, debt that can actually lead to possible demise of your organization, because the debtors have right to the people who are giving you debt have a right to even go on in take your company to insolvency, depends on the contract that you sign with them. But it can add value to your initial stages, because where you will not dilute your equity, so you will have a better options to raise equity at the series A, or when you want to grow a scale. But it also kind of looks at you from a fact that you have to be very, very sure that this is the amount that I will repay back at this particular time.
Yeah, I would just want to add one or two things here. One is, of course, what she says, completely agree with that. Two is you must be very sure of what your gross margins are, you know, and the cost of debt that you're going to incur. Now that's one. Two, you could also, if at all you decide to go for debt, you could also talk about in the agreement, the repayment terms. Instead of, let's say, monthly, can I negotiate a quarterly repayment? Can I negotiate a one-time repayment after a year and a quarterly interest payment? So things like that can help you tend over the cash flow part of it. So these are the two things that I thought.
Thank you.
Thanks. Do we have time for maybe one more question? Yeah.
Hi, my name is Kumar. Thanks a lot for the wonderful session. I'm a first-time founder and an early-stage founder. Most of you have raised debt after Series A. So can one of you talk about how do you look at financing before Series A, like in terms of pre-seed, seed? It's all VC funded, I understand, but when do you look at pre-seed? Where do you look at seed? Can you talk a bit about that? That'd be helpful. Thank you.
Yeah, so I mean, just to clarify, FinQY has not raised Series A yet. We still to be there, though we are over 15 million in our current, ARR. So, but I think they'll be able to better answer that.
I think I would agree with what Suvidha said there, that it's not about what stage you are in. Do you have the means to repay, right? I think that becomes, do you have a predictable revenue stream that you can utilize to pay back? I think that should be your call to say whether you can take debt, yeah? And if you can structure that debt in a manner with what you can have as a possible future cash flow prediction, and structure that as a quarterly payout or a half-yearly payout or a monthly, I think that would be the way to balance this pre-Series A, right? So I don't think there's a right answer to say what's the way to do it. It really is about what is your necessity and why would you want to raise that money, right? If you're raising Series A largely for growth, because that you can't, it's not advisable in any manner to kind of raise debt to drive growth, unless you are 100% certain that the bet that you're going to take is going to work. Because if it doesn't work, then it can lead to a situation where that's the end of the business as well, right? So I think it's a call that you need to take depending on why you need that capital.
Okay.
You can also add options like, a convertible debt wherein you take a debt and that gets converted into equity at some point of time with an option. It may or may not have an option. So it all depends on what stage you are, in a sense, of your growth or of your journey as a product or what you're selling. It all depends on that. Like what he said, there's no right answer to that.
Okay, got it. Thank you.
Thanks again for that. I believe we're just on time here. So once again, would like to thank firstly our three panelists for today. I believe they might be staying back as well. Do feel free to interact with them. So Puneet from FINQY, Suvidha from Synup, and Rajeev from Mystifly. And once again, thanks so much to SaaS Insider for inviting us back as a sponsor. Feel free to swing by. We have ECL team at our gold sponsor booth. We're incidentally also sponsoring the 1 to 10 million track. I hope this discussion has been as insightful for you all as it has been for us, and look forward to continuing the conversation. Thank you all once again.
Yeah, thank you.
Thank you. Thank you, sir.
Thank you all.